Long-Term Capital Management 1998. They called it the smartest hedge fund on Wall Street. Two Nobel Prize winners, a team of PhD mathematicians, and a strategy that seemed impossible to lose. This is the story of long-term capital management and how it nearly broke the global financial system. LTCM was founded in 1994 by John Meriwether, a legendary bond trader from Salomon Brothers. His secret weapon, Myron Scholes and Robert Merton, the men who literally wrote the formula for pricing options. The Black-Scholes model, the foundation of modern finance. The strategy was elegant. Find tiny price differences between similar bonds. Two bonds that should trade at the same price but don't. Bet that the gap will close. With enough leverage, even a tiny convergence becomes a huge profit. For 4 years, it worked perfectly. Investors earned 40% annually. Banks fought to lend them money. Everyone wanted a piece of the genius. By 1998, LTCM had $4.7 billion in capital, but through leverage, they controlled over $125 billion in assets. Their derivative positions exceeded $1 trillion in notional value. The leverage ratio was staggering. For every dollar of their own money, they had borrowed 25 more. Then came August 1998. Russia defaulted on its government debt. Global panic erupted, and everything LTCM believed about markets turned out to be wrong. Spreads didn't converge, they exploded. Investors fled to the safest assets they could find, U.S. Treasuries. The bonds LTCM was betting against went up, the bonds they owned went down. Every trade moved in the wrong direction simultaneously. Margin calls arrived daily. The fund was bleeding hundreds of millions per day. In a single month, they lost $4.6 billion, almost everything. By September, LTCM was hours from total collapse. And here's the terrifying part. The fund was so interconnected with every major bank on Wall Street that its failure could have triggered a cascade, a global financial meltdown. The Federal Reserve stepped in. 14 banks were pressured into a room and told to inject $3.6 billion, not to save LTCM, but to save everyone else. The lesson? Markets don't care about Nobel Prizes. Leverage amplifies everything, including mistakes. And when everyone runs for the exit at once, even genius can't find a way out.